You've heard about ETFs, index funds, mutual funds, and hedge funds. But do you really know the difference? How each one works? What they cost? What the risks are? And more importantly, which one makes sense for you? Today, you'll understand in a technical, clear, and definitive way the four main types of investment funds that move trillions of dollars globally. No fluff, straight to the point. Let's dive in. Let's start with the oldest, mutual funds. They emerged in the 1920s and still dominate the American market today, with over $20 trillion under management. What are they? Mutual funds are investment funds where a professional manager actively chooses where to invest shareholders' money. You buy shares of the fund, and that money is used to build a portfolio of stocks, bonds, or other assets. The proposition is simple. The manager will try to beat the market. They analyze companies, study balance sheets, project scenarios, and make strategic choices to deliver returns superior to a benchmark index, like the S&P 500. How does it work in practice? You don't buy ANZL shares throughout the day. The share price is calculated once per day at market close based on the NAV, net asset value, which is the total value of the fund's assets divided by the number of shares. If you want to enter or exit, your order is processed at the end of the trading day. Now comes the problem: the fees. Mutual funds charge an annual management fee, so led the expense ratio, which ranges from 0.5% to 2% per year. Sounds small? It's not. Over 30 years, a 1.5% annual fee can consume more than 30% of your final wealth because of compound interest. And there's more. Many mutual funds charge load fees, entry or exit fees that can reach 5%. You start losing money from day one. And the performance? Here's the dirty secret of the market. Most active mutual funds don't beat their benchmark index over the long term. According to studies by S&P Dow Jones Indices, over 90% of active managers underperform the S&P 500 over 15-year periods. Why? Because fees erode returns, and consistently predicting the market is impossible, even for professionals. Advantages: automatic diversification, professional management, access to complex strategies. Disadvantages: high fees, mediocre performance on average, limited liquidity, only redeems at end of day, low transparency. You don't see exactly what the manager buys in real time. Do mutual funds make sense? For most people, no. In 1976, a man named John Bogle had a revolutionary idea. What if, instead of trying to beat the market, we simply copied the market? The first index fund was born, the Vanguard 500, which replicates the S&P 500. What is an index fund? It's a fund that replicates a market index. It doesn't try to pick the best stocks. It buys all the stocks in the index in the same proportion. If Apple represents 7% of the S&P 500, the fund buys 7% Apple. If Microsoft represents 6%, it buys 6% Microsoft, and so on. How does it work? Index funds also calculate NAV once per day, just like mutual funds. But there's a crucial difference. They follow a passive strategy. There's no manager doing analysis or trying to predict the future. The fund only needs to adjust the portfolio when the index changes, which happens rarely. Result: minimal operational costs. Fees. Index funds charge ridiculously low expense ratios. The Vanguard S&P 500 Index Fund charges 0.04% per year. That means for every $10,000 invested, you pay $4 in fees per year. Compare that to 1.5% of an active mutual fund, $150 per year. It's a brutal difference. Since index funds simply replicate the market, they deliver exactly the index's return minus the small fee. And here's the genius insight. Since most active managers underperform the market, index funds end up beating 90% of mutual funds over the long term, simply by not trying to be too clever. Warren Buffett, the greatest living investor, recommends index funds for ordinary investors, and he bet $1 million against hedge funds, proving that a simple index fund would beat complex portfolios over 10 years. He won. Types of indices. There are several major indices you can invest in through index funds. For example, S&P 500, which includes the 500 largest American companies. NASDAQ 100, focused mainly on technology companies. Russell 2000, which tracks smaller companies. MSCI World, representing global developed markets, and MSCI Emerging Markets, which covers companies from emerging economies. What is tracking error? Tracking error is the small difference between the fund's return and the index's return. It usually ranges from 0.05% to 0.20% per year, and it happens because of operational costs and portfolio adjustments. Now, let's talk about the advantages of index funds. First, they offer very low fees, which means more of your money stays invested and working for you. Second, they provide predictable performance because the fund simply follows the index. No surprises, no guesswork. Another strong point is automatic diversification. With a single investment, you get exposure to hundreds, sometimes thousands of companies. And finally, you get total transparency. You always know exactly what the fund is tracking. But there are also a few drawbacks you should be aware of. Index funds have liquidity only at the end of the day, so you can't buy or sell instantly like individual stocks. You'll also never beat the market. These funds are designed to match the index, not outperform it. And of course, during market crises, the fund will fall along with the index, since it mirrors its movements exactly. Now let's talk about ETFs, exchange-traded funds. They're very similar to index funds, but with one powerful difference. ETFs trade just like stocks. So what does that mean in practice? With index funds, you buy or sell only once per day, at the end of the trading session, at the fund's net asset value. With ETFs, you can buy and sell anytime during market hours, in real time, at the current market price. How do ETFs work? The magic of ETFs is in the creation and redemption mechanism. Imagine you want to create an ETF that replicates the S&P 500. You need to buy all the index stocks in the correct proportion, deliver those stocks to a custodian. In return, you receive ETF shares. This process is done by financial institutions called authorized participants. They create new shares when there's demand and redeem shares when there's excess supply. Result? The ETF price always stays very close to the real value of the assets it represents. Now let's talk about passive versus active ETFs. Most ETFs are passive, meaning they simply replicate an index. But there are also active ETFs, where professional managers make strategic decisions in an attempt to outperform the market. And there's more. We also have thematic ETFs. If you want to invest only in artificial intelligence, there's an ETF for that. If you prefer clean energy, there's an ETF. And if you want exposure to blockchain, yes, there's an ETF for that too. Some popular examples include SPY, which tracks the S&P 500, QQQ, which follows the NASDAQ 100, ARK, an active ETF focused on disruptive innovation, VO, another S&P 500 ETF from Vanguard, and VTI, which represents the entire US stock market. In short, ETFs give you several ways to invest, passively, actively, or by focusing on a specific theme. ETF fees are measured through the expense ratio, which represents the annual percentage charged to manage the fund. Most ETFs fall within a very efficient cost range, typically 0.03% to 0.75% per year. Passive ETFs, which simply replicate an index, are the lowest cost option, usually between 0.03% and 0.2%. Active ETFs, where managers actively select and adjust positions, have higher fees, generally 0.50% to 1%. Thematic ETFs, focused on specific sectors like AI, clean energy, or cybersecurity, tend to sit between 0.4% and 0.75% due to specialized research and narrower portfolios. Even with these variations, ETFs remain significantly more cost-efficient than traditional mutual funds, making them a preferred tool for long-term investors seeking low expenses and broad diversification. ETFs come with several important advantages. First, they offer intraday liquidity, meaning you can buy and sell shares at any moment during market hours. They also provide low fees, instant diversification, and full transparency, since you can see every asset the ETF holds. Another key benefit is tax efficiency, because ETFs typically generate fewer capital gains distributions. However, there are some limitations to consider. You may face brokerage costs, since each buy or sell order can trigger a trading fee. There's also the bid-ask spread, the small gap between the buying and selling price. And in ETFs with lower trading volume, the market price can temporarily deviate from the fund's NAV, the net asset value. Overall, ETFs are ideal for investors seeking flexibility, low costs, and broad diversification in a single instrument. Now let's move to the very top of the investment pyramid, hedge funds. Hedge funds are investment vehicles designed for qualified investors, people with significant capital. In the United States, that usually means having at least $1 million in liquid assets. So why do hedge funds exist? Because sophisticated investors don't seek relative returns. They're not impressed if the S&P 500 goes up 10%. Their goal is absolute returns. They want to make money in rising markets, flat markets, and even when the market is falling. To achieve that, hedge funds use advanced and aggressive strategies like short selling, leverage, derivatives, and complex trading models. Higher potential returns, higher risk, and much higher skill requirements. So how do hedge funds actually make money? Here are the main strategies they use. First, long and short equity. They buy stocks they believe are undervalued. That's the long side. At the same time, they short sell stocks they believe are overvalued. This allows them to profit when great companies rise and when weak companies fall. In other words, they don't need the market to go up to make money. Second, global macro. This strategy bets on massive economic forces: interest rates, currencies, inflation, and commodities. A legendary example? In 1992, George Soros bet against the British pound and made $1 billion in a single day, breaking the Bank of England. Third, arbitrage. Here, hedge funds exploit small price differences in related assets. If a stock trades at $100 in New York and 101 in London, they buy it where it's cheap and sell it where it's expensive. Tiny gaps, executed at massive scale. Fourth, quantitative strategies, also called quant. These funds rely on algorithms, data models, and artificial intelligence to spot patterns humans can't see. Renaissance technologies. The most famous hedge fund in history used pure quantitative strategies and delivered an average return of 66% per year for over 3 decades. And fifth, distressed securities. These funds buy assets from companies in crisis, bankrupt, mispriced, or abandoned by the market. They bet on recoveries, restructurings, or forced asset sales at a discount. It's high risk, but potentially massive reward. And continuing our breakdown of hedge funds, now let's get into one of the most misunderstood parts: leverage. Hedge funds don't just invest the money they have, they borrow huge amounts to amplify returns. If a fund has $100 million and borrows another $300 million, it now controls $400 million. A simple 10% gain turns into a 40% return on the original capital. But the same happens in reverse. A 10% loss instantly becomes a 40% hit. Leverage is powerful and dangerous. And now, let's talk about the part everyone loves to hate: the fees. Hedge funds are famous for what's called 2 and 20. They charge 2% per year just for managing your money, whether they win or lose. And then they take 20% of all profits. In a $1 billion fund producing a 30% return, that's $60 million straight to the manager. This is why many hedge fund managers rank among the wealthiest people on the planet. But all this power comes with massive risk. And history has shown us what can happen when leverage goes wrong. Think of long-term capital management, a fund run by Nobel Prize winners that nearly triggered a global collapse in 1998. Or Archegos Capital, which evaporated $20 billion in days because of highly leveraged bets. So yes, hedge funds can deliver enormous returns. They use advanced strategies, they can profit in rising or falling markets, and they have more flexibility than almost any other investment vehicle. But they also come with extreme risk, huge fees, limited transparency, and lockup periods where investors can't withdraw their money for months or even years. In short, hedge funds are designed for people who can lose millions and still sleep at night. Now that you understand the 4 types of funds, here's the quick comparison. Mutual funds. Active management, high fees, average performance, and end-of-day liquidity. For most investors, not the best option. Index funds. Passive, very low fees, predictable results, and simple long-term growth. Great for investors who want low cost and stability. ETFs. Passive or active, low fees, and the big advantage: you can trade anytime. Ideal for anyone who wants flexibility and instant diversification. Hedge funds: aggressive strategies, extreme fees, and high risk. Built for ultra-wealthy investors who can handle big losses. Bottom line: for 99% of people, the smartest strategy is to stick with low-cost index funds and ETFs. Hold them long-term and let compounding work for you. Let's do a quick recap before we wrap up. Mutual funds: expensive, inefficient, better to avoid. Index funds: simple, low cost, consistently effective. ETFs: flexible, affordable, and ideal for most investors. Hedge funds: high risk, high fee, meant only for millionaires. Now you truly understand how each fund works, what it costs, and which ones actually make sense for your portfolio. If this video helped you, subscribe, hit the like button, and share it with someone who needs to finally understand finance the right way. Thanks for watching, and I'll see you in the next video.